All right, so now that we're being recorded, so that's good. So this is sort of the pivotal point in the course where after the end of this week, we are halfway through, which would be the end of week 4. So we're 8 weeks, 9 weeks total with the exam dates. So what I see looming is your midterm exam, which I'm planning for sometime next week. I haven't decided what that looks like. And the reason I want to give you the weekend to at least prep for that, but really just wondering what it's going to look like in terms of time. What I'm hoping to do is give you some sort of like 24-hour period to finish it. And so it's not just a timed event where you're having to manage your workload and work, family, and of course, our changes and responses to COVID has shifted a lot of what we do and how we do it very quickly over the weekend anyways here. So it's meant a lot of reorganization, a lot of adaptation and reorganization of our lives. So I'm taking all that into consideration and trying to balance this out as best as possible. And so I don't want to delay it too much longer. I do need to think about this midterm, but I just don't think it's going to be a sit down, you do it in 2.5 hours. It's going to be probably more of a take it for 24 hours and work on it and hand it in. So it is a graduate program. So that's what I like to do in this environment. I think you learn more that way than sitting down for, 2 hours to test your memory. I really like to make it applied, something that's real. And so you can use these tools that you are presented with and find out how useful they can be. So that's my plan for that. Please, I do have a note here for myself to send you updates on what that looks like, but I would like to give you that time to work through those assignments. I probably will make one more assignment, just a real quick one that covers what we discussed this evening, because it's quite a big part of the financial accounting piece. And this is sort of our last stop for financial accounting. And if you take anything away from financial accounting, this material tonight will be probably the material you would use the most in terms of making financial decisions. So it's a bigger piece to the decision-making in financial accounting. We'll look at other decision-making topics in the managerial side after next week, or after this week, I guess. And so this chapter becomes not only important in terms of the material, but just in utility. It will probably be the most useful material that you will use. And even for the folks that are, very keen on financial accounting already, this is always just something we continue to use. And they're fairly easy tools that we have here. It's just a matter of understanding what those are. And I'll talk through that as we work through the different pieces. So what I'll do now is first, I'll just share my screen with you just so we can all get on the same page here. But I'm just wondering, I just want to open up the floor. Are there any questions or things that we need to check up on? Just making sure everyone's okay. Any questions? So far, so good. Okay. Of course, questions at any time, please ask through the material, or at the end of the session, please ask, or just jump in.
Yeah, one quick question, Professor.
Sure.
So what would be the nature of the questions? All MCQs or?
No. No MCQs. This, the way I envision this exam is basically a 24-hour take home, or not take home, but it's basically 24 hours to work on it. And so what I normally do with that is I give you, normally a set of financial statements, and there's a series of questions. So you'll be provided with options. I like flexibility in exams. I like to see, how you can utilize those options. And it'll basically be a written type report. Not an academic report, but basically just reporting back in answering questions about your statements that are provided. So it's just a matter of you pining through, and I'll be asking questions about the financial statements and how they impact managerial decision making. So that will be sort of the nature of the. I don't even like calling it an exam. It's not really an exam. It's just basically a I guess, an exercise to demonstrate your knowledge and understanding. Maybe that's an exam, I don't know. But it's not going to be a series of short questions and multiple choice. I don't see much utility in accounting for those types of questions in accounting, because it's more about decisions and explaining things to people. Because how I see you using this material is in that advisory role. You know, you're sitting at the table, decision making with other folks, and you'll have to understand what that discussion entails. What is actually being discussed, and how can I help in making these decisions? So a lot of the material, especially what we covered this evening, we'll kind of bring it all back together again, because we'll be looking at a set of financial statements actually. And you'll be familiar with the line items in the financial statements and the names of the financial statements. And that's what's really important. I'm not really worried about the preparing side, and you are set with financial statements, and how do you use them in decision making? That is the bottom line. And the other bottom line is, how are we assessing this company in terms of its ability to generate future cash flow? And so that's kind of the gist of what the exam will look like. I haven't picked the financial statements yet, but they will be real ones that you'll be able to demonstrate your understanding of. So yeah, they'll be very guided questions for you. So it's not something you have to do research for. It's just a matter of how would you explain the questions in terms of the financial statements that are provided. That's all I can say right now. Hopefully that helps a little, I hope.
Yes, it does.
Okay, great. Thank you. Okay, so chapter 9 in this book talks about financial analysis or financial statement analysis. And I'll be looking, I'll provide a real set of financial statements, and it's a really interesting company in terms of where they are now. So I'll keep you at bay with that, because I want it to be a bit of a surprise. So we'll talk about what we're doing first, and then we'll go look at the statements to see how we can use all of this. But what I really want to talk about is looking at the quality of earnings on financial statements, horizontal and vertical analysis, and then the performance analysis in terms of using ratios. Now, one thing that I want to just state up front with this information is that you're not expected to memorize this. In most cases, you'll be provided the tools to understand what these are. You don't need to memorize any equation. Actually, in fact, a lot of the financial statements and a lot of the corporate entities, the ones that are publicly traded anyways, have all this information, or most of it, on the website or on a listing. And the analysts are doing all the work for us. So it's not a matter of doing the work, it's a matter of understanding what it's telling us. So what is this data telling me? And how do I know it's good or bad? And that's what I want the takeaway to be. So the objective of this material is, how do I understand it to make better decisions? Yes, I'll need to know how it's calculated, because I need to know where the information is being taken from in the financial statements. But you're not expected to memorize any of this. It's just not realistic. That's not why we're here. It's basically trying to understand two things. Okay, three. Overall, what is the company's ability to generate future cash flow? That's one. We've talked about that. But what is the company's financial position and the condition? That's what we want to know. We want to just peel back the layers a little bit away from the financial statements. So when we look at the financials, we're looking at, okay, well, how do we know if the earnings are high quality earnings? What are we looking for? Well, I'm looking for consistency and sustainability in earnings, meaning I don't want to see spikes. I don't want to see drops. I want to see consistency, give or take a few $1,000s. Okay, then that's expected. But that will give me better insight into what's in the future. So how can this company, amongst other information I get, continue this pattern? So what I want to look for in the financial statements are some really unusual items, things that aren't expected to keep happening every year. So for example, a company that discontinues a segment of their operations. It's not profitable anymore. They've decided to let it go. There's a loss on sale or a loss on disposition. So we don't expect that to happen again. Okay, so I note to self, I know that. Other comprehensive income is really just looking at non-operating income. So not everyday operations, other things that have happened, like a disposal of an asset, foreign exchange gains or losses on an investment or something like that. But it's sort of not regular. It's not an everyday thing. So in this case here, they talk about, you know, very specific items. I mean, most of this income statement, of course, is very simplified, but we kind of get the idea, you know, income from operations, great. Other revenues or expenses, gains and losses, which means that $20,000 is not part of regular operations. So as the user of this statement, I would go, oh, okay, great. So this might not show up next year. Okay, so I know that. And then income tax, of course, is based on income that's provided. Discontinued operations, net of tax. Okay, discontinued operations, I would expect this not to happen or occur in the next year because this is kind of like a one-time thing. It shouldn't happen again. And if it does happen again, they're in trouble. But we'll find a note to this in the statements. We'll know why they did this. And then other comprehensive income net of cash, or sorry, net of tax is basically outside of the general operation. So these are items we don't normally see on financial statements or the income statement, but we can see them. But when we do, that's not expected to continue. Okay, they are anomalies. And so the quality of earnings would be something to the effect of, you know, yes, these things have happened. This comprehensive income is $186,000, but it might have been more. Or less, given these unusual items, but they're not expected to last year after year. So in this case here, we see a lot more detail. Now, you probably won't see details like this on the income statement. You'll be referred to a note, and the note will give us this information. But really what they're doing here is it's just expanding. What is this discontinued operations? What happened? So they have this plastics division, okay? There's a loss on operations, but there's a gain on disposal of the division as well. And so it's a combination of two activities. And then the other comprehensive income is this unrealized gain of this for sale securities or available for sale securities, which is beyond our scope here. But what it's really saying is this is not normal everyday operations. These are a result of a separate operation or an investment or something else that they may have carried on their books for a very long time. But now we're seeing the effects of the dispositions. So we don't expect to see them again. And you'll be able to notice this when you see the comparative information, which isn't shown on the statement. They just show the current year. But we do need, and you can see how important it is to have comparative data because we don't really know until we see something that compares to it. That's how we measure things. Adrian, you have a question?
Yes. So my question is, if it is that it is discontinued, why is it on the statement repeating on the statement?
So if it's a loss on operations, it shouldn't repeat on the statement. It should just be a one-time thing that happened that year. And what they're recognizing is that and we sort of discussed this during the asset depreciation chapter, where if we dispose of these assets, it's based on a book value. So the gain or loss is based on the book value disposition. And so we don't expect that to happen again because that asset is gone. So we shouldn't really see it every year. And if we do, we should be getting concerned because that's sort of a sign of liquidation. Right.
So just a follow-up question quickly. So is there like an amount of times that you should be able to see this on the statements, or is there an allowable? Because as you rightfully said, you know, if it is there, it's a concern, right? So what if you've seen it like, let's say, twice or three times on an annual statement? How like is there any set time that it should be there or not?
Well, I think as an investor, you even after the second year, you go, wait a minute, what's really going on here? You might get some information from management because management is really the one who are preparing the statements. So they should be disclosing in the notes what is happening there. And if they're not disclosing that in the notes, they'll be disclosing it in the other document that's called a management discussion and analysis, and it's a separate document that supports the strategy. So if the management discussion and analysis, or we call it MD&A, if it's alluding to, you know, oh, we've got these wonderful plans for the future and we're expanding and all these great things, but then you look at the financials and go, well, it doesn't seem that way. And
Right.
the messaging is different in the financial statements than the marketing piece, which is the management discussion piece. Then there's inconsistency and
Right.
revert to is the financial statements, because the financials are capturing all of those transactions. So if you are seeing things that are repeating themselves like that, like non-operational losses, then I would be concerned. Absolutely.
Thank you so much.
Yeah. Actually, another thing you could do is you could look at the cash flow statement those same years, and then you get a better idea of how cash is moving through the company.
Ah, okay.
Yeah,
Okay, I see what you're saying.
or where it's not moving.
And
Thank
Professor, just
Yes. Mhm.
quick question. This
Sure.
discontinued operations is the number could be positive and negative, or like it should be just always loss. I mean, it's always loss, or can
Not necessarily, because you're disposing of an asset. So if management decides that they're not going to operate division B, okay, so maybe it's a segment, it's a
Mhm.
somewhere regional, they decide to shut it down because it's just not profitable. They could still sell the assets from that, which could still be generating gains on those sale. So even though we're disposing of a division, we could be realizing a gain on the assets. But I think what, you know, and these decisions don't come lightly. So we would have to understand that they've done their analysis, or maybe their strategy is changing, and that this will be interesting after COVID, how many companies change their operational strategy. And they just have to carve off assets. They just can't afford to run them or keep them in order to keep profitabilities rising. So it's not necessarily a bad thing. It could be something where they are looking at, you know, gaining efficiencies, economies of scale. You know, maybe they're integrating their operations in some other way. So just because it's a disposition or they're disposing of an operation isn't always negative. It could be better for the company. I guess.
Okay, thank you.
Explaining it kind of a long-winded way, but hopefully that helps. Yeah, they're great questions though. Thank you. Again, back to the quality of earnings then. Most financial statements should be transparent, especially publicly traded companies, because without transparency, the market's still going to demand the information until it's happy with what it has. So regardless, companies are going to have to keep producing it until the market is happy that they have enough information to make decisions. And that's demonstrated through a lot of theories, efficient securities market theories, et cetera, that we demand information until we have enough of that information. We'll never get all of it, but we have enough, and the market balances out that way. So, you know, we talk about this quality of earnings and we talk about different things that we see or items that we see on the income statement. And so we're looking for consistency, we're looking for comparability, and we're looking for, you know, the anomalies that we know probably won't last. The other thing that doesn't really get talked about much in this book is the use of non-GAAP accounting principles. And what that means is that for some reason, the preparers of the statements don't feel that, for example, International Financial Reporting Standards, or a standard, doesn't quite fit their operations or this transaction. So what they have to do is they have to disclose which principle they should be using and why it doesn't fit. And then they'll present it in a different way. So at least the user knows that, okay, this is the way it would have been, but this is how it's being reported, because it's supposed to provide better information to the user. If they don't disclose that, the regulators don't get very happy. Now, there's not much the regulators can do. It's becoming quite pervasive, and the International Financial Reporting Standards and the International Accounting Standards Board fought it for so long. But it used to be around 30% of publicly traded companies were using non-GAAP. Well, now it's past 60%. They couldn't fight it. They just couldn't beat it down. So they compromised and said, fine, if you want to use non-GAAP reporting, you must be transparent and disclose why it doesn't fit and present the user the detailed information as to why you are presenting it this other way. So it is disclosure, and it's a higher level of disclosure. So the quality of earnings can actually improve, even though it's not comparable because of this non-GAAP issue, but it's fully disclosed. So investors and other users make up their minds of, to determine whether or not they feel the earnings are of high quality or not. But we really just have to think about, I think if you have a company in mind, you kind of have a bit of a knowledge about their past reports. And if you go on any website, publicly traded company, they have an archive of financial statements. So you can actually go back quite a few years and you can see the trends from all those times. So you can see how their earnings have been impacted in the past. And so these alternative accounting methods, which we talk about, non-GAAP, we talk about the different inventory recognition. LIFO is not allowed in Canada, so we just look at first in, first out, but the way we cost inventory for financial reporting can be different for different companies. If we look at pro forma income, which is just another way of saying budgeted income, which we don't really report on, we just don't. Some companies might want to because it looks better, but not really the thing you're supposed to do. And if they're audited statements, you will definitely not be doing that. So again, it just, companies are trying to position themselves in the market that are favorable. And this is why they resort to these other ways of reporting earnings, because they know investors are going to respond positively. They know that analysts are going to respond positively. And when that happens, the share price goes up and it looks good on management. So reputation becomes a big part of this incentive to purify or qualify earnings as being good quality earnings. But you just have to be careful when you're going through the financials because you need to understand what types of reporting they're doing. So an example, if managers are feeling pressure to increase earnings, they may misalign the principles. So revenue recognition is a big one. Management can decide when they'll recognize revenue. So they could recognize it in the current period when in fact it should be reported in the following period. And they call this like a channel stuffing. They'll just stuff it as much as they can. The thing with this is it eventually catches up with them over the years. So capitalization of operating expenses, because it takes it off the income statement and puts it on the balance sheet. Of course, then income goes up. And then of course, things like Enron, where they had a lot of off balance sheet financing. So it never appeared on their balance sheet. So the debt section was light when actually there's a lot of off balance sheet financing, which was part of their demise in the end. If you haven't seen the movie, I highly recommend it. Smartest guys in the room. That's what the movie's called, but apparently they weren't. So they were for a time. They had a lot of people swindled until people started digging a little deeper because things just didn't make sense. So eventually it catches up. So word of caution, just do it right the first time. That's the best way to do it. In terms of analyzing statements, what we're really looking for is, oh, I see a question there. Is really just looking for, let me see what I have here. Yeah, I wonder about the one standard too. The only thing one standard is that it reduces flexibility and not all industries are the same. So it would be really simple and it would be really nice. I just don't know that the market would be favorable to that. Yeah. And in the International Accounting Standards Board is really trying to design standards for the users. They're trying to make it easier for us. The companies, if that guidance wasn't there, would do whatever they wanted, which is what they don't want. So again, I guess it's more of a, these standards that must be followed. And so the standard setters are trying to keep up with what is most relevant for users. So one model would be great. Yeah, it'd be a lot easier. So analyzing financial statements, we're really looking at comparative basis. So we need a number of years of financial statements to do a really good analysis. A really thorough analysis is probably about 5 years worth of data, because you can establish a really solid trend that way. You can do intercompany or intercompany, within the company or a group of companies. You can also take industry averages if you want to research that. And really just the basic tools of how we do that. We do horizontal or vertical analysis and ratio analysis. So you can do all three if you want to, but it really just depends what you're trying to get out of it. The one thing I will say about the horizontal and vertical analysis is that it kind of adds another layer to your understanding of the financial statements and the overall performance financially, because you're kind of given this different lens to look through. And what it's doing is it's actually showing you, it's not just a number anymore, it's a change or a percentage change. So the change numerically might not sit, it might not have impact. But once you turn something into a percentage, it's quite impactful and it gets your attention. So this is what the purpose is behind this horizontal analysis. So the way that we do that is we want to look at the increase from last year. So you take the current less the previous year, divide by the previous year, and this gives you a percentage increase or decrease from the prior year. So when we do that, we get a sense of, it becomes a bit more intuitive, I suppose. And so here on the far right-hand side, what we see here is the change, right, between the 2 years, 2016 and 2017. There's been an increase in current assets by $290. So $290 on its own, in thousands, of course, might not seem like a lot, but converted to a percentage, it's almost 12% change. That's a big deal. That's good. But we don't get that until we actually convert it to a percentage. So in doing that, it's almost, sometimes it's easier visually for management because they might not know the numbers. If you said, well, we had a $290,000 increase from last year, they're like, great. But if you say it increased by 12%, they're like, wow, okay, now I have perspective. So it just adds clarity. It adds substance to any analysis. And then you look at the smaller changes. You have 6.2% in assets, other assets 4%. Current liabilities 0.6, great. They haven't increased. That's a good sign. But look at the treasury stock, so 48%. Of course, that's they're just buying back some stock. And then the shareholders' equity, 22% and change. So it's increased by 22%. Those are good signs. These are good results. But we wouldn't know that unless we converted it. So we're just doing comparative. We're taking current year, prior year divided by prior year, and we get this percentage increase. So it's quick and easy. A nice spreadsheet will do a great job, or if you just want to do it by hand. But if you're sitting at a board table and you're in a group meeting and you're looking over these financials, you do this quick math. Think of how impressive you'd be at the table. It just adds context is what I'm getting to. Now, in terms of the income statement, this is where it hits home because we want to look at the bottom line. Did I make more or lose more? And so here we see, it's a $99,000 difference. Okay, well, that's pretty significant, but it's actually almost 10% increase in net income. That's great. That's really good news. So the 10% increase sounds a bit more significant than a $99,000 because the 99 doesn't really add context for us. It's 99,000 more than last year, but how much more? Well, almost 10%. Okay, now we know. Maybe it adds context because we introduced a new marketing campaign or we closed a division and oh my gosh, we're worried about sales and profits, but guess what? It ended up being 10% more in profit. Now there's context and it just adds a bit more value to the statements. So we do it for both the balance sheet and the income statement and it adds a bit of clarity for us. Now, vertical analysis is not as impactful, I don't think, as a horizontal analysis because this is just looking at a percentage of something. So on the income statement, it's always going to be a percentage of revenues because revenue is really the top of the line, the top line item of a statement. So everything else chips away at it, right? Revenue is revenue and everything else is an expense. So as a percentage of revenue, what does this represent? So where is revenue being consumed the most? And what does that pattern look like? On the balance sheet, it's usually a percentage of assets, or if management wants it to be something else, maybe they make it part of equity. I don't know. It's up to them. Depends what they really want to decide. So a base amount is really what they're looking for. Okay. So in terms of this balance sheet, they're looking at a percentage of revenue, or sorry, of total assets. So here's the total assets, 100%. So current assets represents 23.8%, et cetera, et cetera. But you'll notice that, you know, all of these, it's a balance sheet. So assets equal liabilities plus shareholders' equity. And so we'll look at it in terms of a percentage of total assets. So again, it's, you know, it can be anything. They can make it all of assets. Here they've made it assets and liabilities and owner's equity. So these percentages are representative of this. And it just gives you a better sense of where things have been tied up. So current assets, 23.8%. Last year is 22. Well, not much change. Not much change across the board at all. Really, when you look at these statements, there's, with the exception of treasury stock, there's really not much difference or much room for concern. They look pretty standard. Retained earnings obviously have increased. Good news. That's good news. There's earnings. And so no alarms. I don't see any alarm bells going off here at all. Not for this one. Looks pretty standard. We have to allow room for flexibility and variability, but they're not variable by much. In terms of the income statement, you know, again, a percentage of revenues for both years, it'll be the same because we want to compare with the same data. And so this cost of goods sold represents about the same each year, 56%. So, you know, give or take a little bit. So gross profit is 44% and change for both years. So that's consistent. So really what that's telling us is we have 44% of our revenues left over to cover operating expenses. So 44% is pretty good. It would be better if it was a little higher because it's a little safer. So maybe we look at cost of goods sold. Maybe we look at the cost of inventory. That's all we can do. Or we control expenses. But profit margins are still pretty good. 9.4% of revenues are being kept. Or in other words, 9.4% of revenues or net sales is being put into retained earnings for future distribution. That's really the big deal. Has it changed much over the year? Not really. 9.2 versus 9.4, I'm not concerned whatsoever. Actually, these statements look really good. There's not much variability. Things are pretty consistent. No change is good change. If we look at two different income statements, two different companies, we see a different comparison because now we're looking at two companies we might want to invest in. So this is a really interesting comparative because if I go right to the bottom line, net income, because I know that folds into retained earnings, which means dividends for me in the future. Not much difference, a slight change, but not much. You know, 9.4 versus a 10.2. Okay, pretty comparative. We want to see more of a trend. Maybe we want to see something for 3 or 4 years to see, you know, if there's much change, but for the most part, that looks pretty safe. In terms of gross profit, 44% versus 35.6, but Giant Mills doesn't have as many operating expenses, so it's retaining more income. So again, you're having to look at, you know, how cost effective is Chicago cereal versus the Giant Mills. It just depends what the other years look like. But for now, I think that this looks pretty comparable. Low risk, in my personal opinion. Any questions about horizontal or vertical analysis? So far, so good. Great. All right. So now the fun part, analysis. And this is where we get into the nitty-gritty of the financial statements, and we're going to dive a little deeper. And this is where I also say you don't have to memorize these formulas. They will always be provided, and you will always have access. The key thing with this part is to understand what they are telling you. In all of my exams I've ever done for financial accounting, I maybe have asked students to do 1 or 2 calculations, but for the most part, the results are provided. Because I know you can do math. A calculator can do the math for you. What I want to know is, what does it mean? How does it help you with your decision? What is it telling us? What are the results saying about the performance of the company? What kind of financial condition is this company in? So that's more important to me, and that's more important to you in making decisions. So don't worry so much, don't get caught up so much in doing the math. That's important, yes, but work on understanding what it's telling you, okay? Because we need to know, whether two perspectives, whether you're going to invest or whether you're management of a company that needs to improve or it can celebrate in the results. So we can look at lots of different comparative bases, but really we're looking at 3 things: liquidity, profitability, and solvency. And there are different parts of the financial statements that we'll be looking at. So in terms of the ratio analysis, the classifications in terms of liquidity looks at the short-term ability to pay maturing obligations. So we're looking at operational, okay? Receivables, inventory, other current liabilities, paying off the payables, the short-term payables, and what that looks like in terms of cash needs. For solvency, what we're looking at is how well can the company maintain itself in terms of servicing debt in the long term? What kind of cash flow supports that? And then profitability looks at, the income statement side of things, like based on sales, what does that look like in the longer term, or how efficient is the company at using its assets to generate profit? And so we get some sort of sense of what that is by looking at the ratio results. Okay, so 3 categories is really top of mind. So to summarize, these are examples of liquidity ratios. Now, liquidity, again, think of, first of all, look at where these assets where would you find these? You'd find these in the current assets section, okay? With the exception of current liabilities, you're gonna see these on the current liabilities section, but for the most part, we're looking at measuring current operations. Current ratio is looking at current assets over current liabilities. So what does that relationship look like, that ratio? We're going to do an example together. Some inventory turnover. How fast do I move that inventory off my shelf? I look at it in terms of times a year and in days, and the same with accounts receivable. How many times, or what's my ratio look like in terms of how quickly I collect the money from my customers and in times per year, versus on an average daily basis? What does that look like? Is it every 30 days? Is it every 60 days? What does that look like? And that kind of gives me insight into the undercurrent of the operations. Like, what is really happening on an average during the year? Now, some organizations may do it monthly. That's a little too refined for me. Quarterly might be better. In terms of looking at every 3 months, how well are you doing? So that's liquidity. Solvency is more, how can we stay fit in the long term, which means, can we pay our debts? Can we pay our bills? So in terms of debt to assets ratio, we really want to see this as being manageable, affordable. So you're going to get a rate. So it used to be that when you applied for a loan or a mortgage or whatever, personal anyways, the bank would always ask you, okay, what kind of assets do you have? Do you have collateral? What kind of loans do you have? Do you have credit card bills, that sort of thing, because they're trying to figure out, what your debt load is and how you can service it in terms of cash flow. They take your income and they do this great math, but 40% ratio used to be the magic number. Anything above that, they would probably not lend you money. They'd also look at credit ratings as well. But this debt to assets ratio, there's too much risk for the bank when it's above 40%. They're not willing to take that risk unless you can demonstrate to them, with other assets as collateral that you can do this. Or usually what happens is you get someone to co-sign the loan because it's less risk for the bank. In terms of times interest earned, what we're trying to do here is say, how many times per year could a company afford its interest payment? Now, if they can only afford interest payment, 1 or 2 times, okay, you're just making the payment. If you have times interest earned about 10 times, you've got great cash flow. You can cover that interest expense 10 times over. So that's one result we really want to pay attention to because it shows us longevity and sustainability. And then free cash flow is basically looking at, net cash provided by operating activities, less your capital expenditures, less cash dividends. What do you have left over? That's what we're looking for. So the cash flow statement gives us quite a bit of insight into that. Now, in terms of profitability ratios, we're going to the income statement. We're going to look at net income. We're looking at earnings per share, gross profit or profit margin, return on assets, basically how well are we utilizing the assets to generate sales, and then asset turnover, of course, how many times are we turning over the assets that we have to do that. And then the last two are more concerned about shares or equity. What's the dividend payout ratio? And a lot of these results, if it's a publicly traded company, the analysts have done all this work already because they know that investors are looking for this. So they'll do it. And then return on shareholders' equity. So these are giving us more of the profitability side of things or the income statement. So you can see where each of them starts to land. So liquidity ratios, the short-term ability to pay its maturing obligations. So basically we come to look at, I think it's actually on the next page here, current ratio, current cash debt coverage, accounts receivable turnover, and inventory turnover in days. And so what this kind of looks like is, let's just do this current ratio here quick. So what does this measure tell us? What we want to see ideally is a 2 to 1. So basically 2 to 1 means for every dollar of current liabilities, I have $2 of current assets to pay it. What this result is saying is, look, the industry average is 1, which is really low. It's not really a safe place to be. 2 to 1 is the best. What I'm seeing here in both these years is 0.67 or 0.6, which means for every dollar of current liabilities, this company has 67 cents of current assets to cover it. So I can't even cover my current assets, or sorry, my current liabilities, because I only have 67 cents for every dollar of current liabilities. I'm not in a good spot here. So whether it's just a timing difference for when I've gathered the data to prepare this, could be, or it's a pattern and it's not a good place to be. So we really need to work on this. What do the measures tell us? Well, again, we want to see this improve. We want to see 2 to 1, 3 to 1 would be better. 1.5 to 1, not too bad, but it's getting closer to the 1 mark, which is not a safe place to be. So these two companies are not actually doing the best. They could be doing a lot better. So we want to see a much stronger result. Receivables turnover. So this is really looking at, on average, how the company collects its receivables for the period. So we grant credit to customers. We expect them to pay it back in 30 days. We know that not all of them do, and that's expected. So we plan for it, or we just extend credit to really good customers that pay their bills. But there could be a time where customers are unable to do that. And I take COVID as an example. When things had to start closing down in the spring, companies were forced out of business. They couldn't open. So how do you pay your bills? And so maybe there are different concessions that were made and different arrangements in terms of covering those payments. So in terms of the coverage, we have two companies again. We have a comparative for Chicago, and Giant Mills is looking at 2017. So 11.9 versus 12.2. So we're looking at times per year. the receivables are turned over almost 12 times. So it's pretty darn close. Higher than the average, which is good, but it's a slightly slower than Giant Mills. So we're collecting them, you know, not too badly. So, you know, it's not as bad as we would think of it. If we convert that to days, which I think sometimes adds a bit more clarity for management, because if they can conceptualize it in terms of days, if you look at any terms on an invoice, it's usually payable in 30 days. So if I'm turning over my receivables every 30 days, it's on track, right? So 12 times a year, so every month, 12 months a year, every 12 months, I'm turning over my receivables. So that's good. I'm collecting like I should be. So that's a good pattern to have. Inventory turnover, kind of the same thing, days versus times per year. But here we're looking at the cost of goods sold and the average inventory. So again, how quickly can companies convert their inventory to cash? That's really what we're doing. Get it off the shelf as fast as you can. So for this company here, we see the average of being 6.7, and these companies are actually doing quite a bit more than that. Not too much more, but enough. So 7.5 times for the current year for Chicago cereal is a little bit higher than Giant Mills, much higher than industry average. It's about 7.5 times per year. If we convert that into days, average is 54.5. We're at 48.7 for this year. Last year was 46, so slight increase. So what this is saying is every 48.7 days, we are turning over inventory on average. So I'm collecting my sales, my receivables every 30 days. I'm turning inventory over every 48 days. You know, a month and a half, that's really not that bad. It's moving. It's much better than it you know, could be, I suppose. Of course, we'd like to see it maybe go a little faster, but this is an average, right? The industry average is 54, so we're doing pretty good. Salesmen are working hard. All right. And remember too, with receivables and inventory, receivables is cash coming in, inventory is generating sales, and it's also generating cash flow through receivable or through a cash sale. So we want to keep seeing that turnover. We really want to look at those and determine whether or not they're healthy rates. In terms of a solvency, this is really looking at debt. You know, how can we serve, how conditioned is the company to service its long-term debt? So debt to assets ratio times interest earned, and then that free cash flow. So in terms of, you know, asking the questions, have they improved over the year? Current year, 78%, still high. Industry average 55, Giant Mills is 55. This company not doing as good, but better than last year. So 78% is really high. Maybe they can manage it, but it's higher risk. If you look at Giant Mills, it's 55%. It's a bit more manageable, but you know, Chicago cereal is going down, but it's still quite high. So yes, the answer to the question is yes, it has improved, but you know, they'd have to liquidate 78% of its assets at their book value to pay all of its debts. So that's a bit too much, it's too high. We certainly don't want to see that. We would like to see a trend coming down, but they're doing well in other parts. So if we're not too sure about that, let's look at times interest earned. How much cash flow can they generate to cover the interest? And this will give us a better perspective in terms of what that looks like. So the average is 5.5, we're at 5.8 for both years. Giant Mills is 9.9. So a little bit better position, but remember their debt to equity ratio, debt to assets ratio was, it was debt to equity. No, it was debt to assets. Debt to assets ratio was what, 55%? Right, so much lower. So the 9.9 is no surprise. They're much more able to cover their interest payments than Chicago cereal, and that's okay. Chicago cereals remain consistent. It's still almost 6 times per year. So they're doing okay. Not as bad as I thought they would be doing. So are they able to service its debt? Absolutely. Okay, so before interest and tax was 5.8 times to cover interest expense. So they're doing okay, even though it's a little high. But that will probably improve the more the debt to equity ratio, or sorry, debt to assets ratio improves. Now, free cash flow, this is really important because in order to pay that interest and other liabilities, we need cash. So what's freed up? Industry average, not available. It's kind of hard to predict. Giant Mills, 895. Again, Chicago cereal did much better than last year, marginally. Not quite as good as Giant Mills, but better than it was last year. So again, net cash provided by operating activities is improving. So we'd be happy with that. So it's more than enough to acquire new assets. And we also know from the cash flow that we can actually pay interest almost 6 times. So it's good. Could be better, but it's good. Return on equity. So if I'm a shareholder, I want to know what the return is on my shares. What does it look like for me? So how many dollars of net income? How much do I as a shareholder, how much did I earn per my share? Okay. So net income less preferred dividends. And why is the preferred dividends just deducted? Well, companies can issue 2 main basic types of shares, preferred and common. Common shares have voting rights, but they don't always get dividends if a company has preferred shares. If a company has preferred shares, they usually cost a little more. They come with a preferred dividend rate. So preferred shareholders get paid first because maybe it's $1 per share. They get paid $1 per share, guaranteed. Now, the company may not declare dividends in the year, but when the company does and they accumulate, the preferred shareholders get paid first. They are in accrual, right? They've accrued to the shareholders. So we see this as being, a better position for a preferred shareholder, but as a common shareholder, I might not get dividends. If the preferred shareholders are paid first, there might not be anything left over for me. But if the preferred dividend shareholders get paid first and there's a lot more left over, I win. So it's one of those things called investment risk. If I want voting rights, I'll buy common shares with the chance that I'll get dividends. Not always guaranteed, but I'm expecting them. Preferred dividends will come with preferred shares. Some preferred shareholders can have voting rights, but it's not as common. So they're trying to refine this. So the common equity return is what we're looking at. So we do have to take out the preferred dividends. And it's divided by the average common shareholders outstanding equity. So here we look at 48 and 46. Okay, consistent. But Giant Mills only 25% and industry average 19%. Wow, give me some of those shares. So the return is really unusually high. It doesn't quite make a lot of sense considering the average is 19%. Maybe it's an anomaly year. Maybe they have less shares outstanding. I mean, we don't know the answer to that. We'd have to look a little deeper, but certainly stands out. We want to investigate that a little further. But so far on the surface, looks pretty darn good. The return on assets then. So really what we want to look at is how do we use these assets to generate profit? So the income earned on each dollar invested in the asset. So what's that return look like for us? And so it makes sense to use net income divided by the average total assets. So you take the total assets, 1 year, 2017 plus 2016 divided by 2, there's your average. And we have, an industry average of 5.3%, and this is running around 10 and 9%. Giant Mills looking at 6.2. So they're using their assets fairly well. But if we think about this note here, they have wait a minute, they had a 48% return on shareholders' equity, which is a little bit high compared to everything else. And now we have this 10% return on assets. So maybe they haven't been, well, there's a couple things. We don't know about the shares and how many are outstanding in comparative to the other company. But they've really made use of this leverage that they have with their assets. So again, it would be interesting to see if this trend happens throughout the years or whether it's just one of those anomaly years. Again, the quality of earnings. But it does catch your eye quite a bit. So kind of takes a step back a little bit. Profits, the income statements. The first place I usually look, because I want to know if companies have made money or not. And how they continue to make money and profit, because that's usually what puts people to work, keeps communities going, and looks at some sort of indication that there's a sustainable practice of business. So here we see profit margin comparative 8.2 versus 9.4. Well, it's 1% higher than it was in comparison to Giant Mills. 6.1% is the average. So Chicago's doing pretty good. But we looked at their turnover ratios as well, and they're doing quite well. So 30 days for receivables, 47 days for inventory turnover. So they're able to generate these sales, and they're keeping their income. The key is keeping it, right? Net income is what we're looking at here as a percentage of net sales, gross sales. So again, it's how much we're keeping. So maybe their cost management practices are quite good. Okay. So again, lots of things to think about in terms of profitability. Now, asset turnover, really looking at how well the companies use their assets to generate sales. Again, this will often depend on the age of the assets, the number of assets, the type of business. This is a cereal production company, so it gives us context in terms of the results. So the average turnover for utility companies is 0.45, for example, while grocery store is an average of 3.49. So it depends on the industry. It really depends on the type of business activity that's being exercised. So again, the industry average for the cereal is 0.87. Chicago cereal is at 1.07. So quite significantly higher, where Giant Mills is a little bit lower than industry average. So maybe that implies that Giant Mills has some older assets and they're not as efficient in terms of what Chicago cereal has. So maybe they've invested more. Maybe that explains the higher debt. Maybe they've had to invest in this newer equipment or newer assets, but it certainly has paid off in terms of how well they use them to generate profit. So it's about the balancing act, right? And it's hard to really know by just looking at the ratios and not looking at the financial statements. But what we're really trying to do is understand what's happening in the company by pulling out to the surface the results of operations. So we can look at the financials on one and then look at the ratio analysis on another, and then really get a really good sense of what that looks like. So a much different way of looking at it. So the combined effects on of profit margin and asset turnover on return on assets is really just showing you, the combination. I mean, we're looking at profit margin and asset turnover, and when you put the two of those together, you're getting return on assets. So if you want to look at them individually, you can do that, or you can combine it into one return on assets. But I think it has a lot of utility by looking at it individually, because it just opens up the door and opens up the crack a little bit more for us to understand what's happening within a company during the year, and how they're utilizing assets and how it relates to sales, production, and et cetera, et cetera. So it just helps us establish our perspective and opinion on the financial position and the financial condition of a company. How fit are they really? And once we unpack it a little bit more, we can see it come to the surface. So gross profit. So gross profit is the difference between net sales and cost of goods sold. What is left over to cover operating expenses? And this is really telling. Because really what this is saying is it doesn't matter what the percentage is. What matters is the difference between gross profit and net income. How much of that gross profit can we keep? So how well are you at maintaining costs? So in terms of gross profit and sales, we just say, look, Chicago cereal is running at 44% both years. Good. You know, they're sustaining that. Giant Mills is 34%. Industry average 30%. That's a really low margin. I'd get a little nervous at 30% because I think it's just too close to the bottom. It's closer to zero. So the further away from zero you get, the more comfort you would have. But it's not to say that Giant Mills can't be profitable. Maybe they're just much better at cost control. So again, it's how management can control costs, right? That's what it comes down to. And then lastly, earnings per share. At least I think it's the last one. Oops, I have to go back, I guess. Let's go back. In terms of, as a shareholder, what the net earnings are per my share that I own. So it's gone up for Chicago cereal here. Giant Mills is $2.90, a much better result. I don't know what the comparative is for Giant Mills. We need to know that to make it fair. There is no industry average. It's hard to do an industry average because it's based on individual earnings per company. But you know, $2.63 a share is not that bad. What it means though is what did I actually pay for the shares? If I paid, you know, 15 cents a share and now it's $2.63, then heck yes, it's doing really well. If I paid $5 a share and now it's worth $2.63, not so much of a good investment. So I guess I'll hang on to them. But it's all relative, right? It's relative to what you paid for them. It's relative that they keep generating at least a profit or earnings per share. That means there are earnings and it's not negative. Okay, when you see a negative earnings per share, it means it's a loss year. So this is good. It might not be a lot, but it's still positive. And that's what we need to be concerned with. Price earnings ratio. I'm not really too worried about this one. It's just reflecting from an investor's perspective, what they see as future earnings. What is their potential for future earnings? So basically the share price versus the earnings that they anticipate. So it's more of a forecasted figure, and a lot of analysts will do this for you. If you go on a Globe Investor page, actually we'll be able to do that together here in a moment. And I'll show you where you can find a lot of this information for maybe one of your favorite companies. I don't know. I'll pick one and see what we come up with. Anyways, so price earnings ratio, just basically looking at, you know, this forecasting ability, what that might look like. So, you know, 20.1 in terms of 24.3 versus 35.8, which is the industry average. Well, hard to say what they're basing this on. It's a lot less than the industry average. Actually, both of them are quite a bit less than the industry average. Maybe there's a reason for that. We don't have all the details. We don't have the financial statements to tell us what's going on. But just based on the numbers alone, we have an inkling that something might not be as strong, or maybe there's higher risk. Or maybe it's just the cereal industry. Who knows? Maybe this is historically this way. So we need to know more information on what that looks like. So a low PE ratio suggests the market is less optimistic about Chicago cereal than about Giant Mills. So it's slightly different, not a huge difference. Or vice versa, it could be underpriced. So again, we need more information to determine that, or make that determination in a more solid way. Now, in terms of payout ratio, again, the ultimate endpoint of owning shares is that I get a return on those shares, and that's in the form of a dividend. Cash is good, stocks are okay, but I prefer cash. So in this instance here, if we compare these two companies, average is about 37%, 45 and 43, Chicago is hovering around, but Giant Mills at 54%. Hard to assess on a couple of years because not all companies declare dividends every year. It might be that they haven't declared dividends for 3 or 4 years. So how do you know? How do you get a better sense of how this can be distributed when companies don't normally declare dividends? So it's a hard one. You just need more information. Again, payout ratios could be, determined by analysts. They have a better, they've got their finger on the pulse in their industry, and they're the experts. So they have probably a lot more information and tools at their fingertips than we would. So why do all the work when the analysts can do it for us? This is an example of, this is Lululemon. This isn't current, but it's just an example of what it looks like. And so what it does here, and this is an example of the Globe Investor page that I mentioned earlier. And so what you see here is basically the description of the company, what it does, where it's located, and a snapshot at that time of different things, price earnings ratios. We look at the dividend dates, stock splits, debt to equity ratio, looking pretty good. Return on assets before tax, return on equity. Profit margin, 16.2%, revenue growth year on year, 21%, very good results. Earnings per share of almost $5. Beta is a risk factor. So Lululemon is really lower risk. It's really close to 1. So really what that means is it doesn't, any market fluctuation like we saw it rallying as the US election was coming to a close, it doesn't respond like to the market. It's just kind of indifferent. Like it does its own thing. So you're not going to see the spikes and drops with a beta really close to 1. So this is giving us sort of a snapshot with some really key results.
Professor, sorry.
Yes, go ahead.
In this case that you're presenting right now, for example, we don't have any average or anything like that. So how we know that, for example, return on assets before tax 20, which is 25.5% is good number. So how we know that?
This is based on an average. So at this point in time, we would have seen, I don't even know what the date is on here. It was in the summer sometime. And so what we'd see is, a 2-month, a 1 month, 5 months, 6 months. So they're giving us time frames. And so they're giving us sort of that perspective. Usually what they're doing here is that they're presenting it quarterly because that's when the quarterly reports come out. So every quarter we can see it change. And so I'll go onto the website and I'll show you what that looks like in terms of the results, but they're usually trying to tie it in with the quarterly reporting, which is required by the regulators. So that's usually how we do it. And you can actually go back and find that history and you can do your own analysis. But the analysts don't always give us everything that we need because every investor is different. They're giving us the bulk. They're giving us the key parts. You notice how they're not giving us, a current ratio or receivables turnover. They're not giving us that stuff. They're giving us what investors would like to know because this is the grit that they're looking for. They want a return and they want, more of a longevity point of view. Yes, they're worried about cash flow and that comes through the profit growth, 21.9%. So on a 5-year average. So the 5-year average is telling us, this has been a really good trend for Lululemon. They're growing so fast and they've been around for, over 20 years. So, but they've made a few changes operationally. So it seems to be paying off for them. But I'll go onto the site and we'll see that there are different quarters that this information is being presented. But it's a good question. Yeah, this information is really kind of cool. And I'll show you the real set of financial statements that we'll go through and we'll do a couple quick calculations. There is an example in the book here that talks about, let's do some quick ratio calculations. They are condensed statements and they'll want you to do a few quick ratio calculations to see. I'm just trying to find, page 369. Right, 369. I think it's here. Here we go. And so really just looking at what we can tell from these statements, like what is it really giving us? So on page 370, they do give you the solutions. And so this is sort of what I was talking to you about. I'm not really worried about the math so much, but let's walk through the results. So if the current ratio for 2017 is 1.5 to 1, but 2016 was 1.7 to 1, what that's telling us is that in 2016, for every dollar of current liabilities, there's $1.70 of current assets to pay them. Well, in 2017, it's going down to $1.50. So their ability to pay their short-term liabilities is declining. Okay, well, it's not too much, but let's see what else is happening in the statements. The inventory turnover, 2.3 times versus 2.4, okay, not much of a change. But let's just convert that into days to see. I mean, it's not much different. So just to get a better sense of how we can see information changing. So 365 divided by 2.4. It's actually not that great. 152 days. So you can do the math on 30 days. It's not looking too good. They're a little slow at turning over the inventory, 2.3 times. We want to see it go much faster than that. So current ratio is declining, inventory turnover is declining, profit margin about the same, so not too much to worry about there. Return on assets, roughly the same, not too much to worry about there. Return on shareholders' equity, it's increased slightly. So not too much of a concern there. Debt to assets ratio, 52.8 to 56. Okay, so it's increased a little bit. That might consume a bit more cash in terms of interest payments. But if we look at times interest earned just below that, we see that, you know, they're generating enough cash flow. I mean, this is incredible. They're generating enough cash flow. They can pay their interest 51.2 times. I mean, that's exceptional. That's really good. So their cash flow is quite healthy. So it's kind of weird because you see this, you know, challenges with inventory turnover where they're not really turning over the inventory. Remember, this is just an average, so it's not specific, but it's something they need to draw their attention to. And then we see return on equity increasing and debt to assets ratio increasing, but times interest earned cash flow is increasing. So some parts of it aren't as great. Profit margins are low, but they're consistent. You know, so it's just kind of hard to know without more information. But I'm not sure I'm 100% convinced with the results. I'm kind of down the middle. They're not exceptional all around. There are a few concerns, but there's some really good results as well, and some are consistent. So we're looking for sustainability in terms of profitability. And we're looking for, you know, a more conditioned company. But I don't know all the information. I don't know what assets they purchased. I don't have the financial statement notes to tell me. So what my point is that yes, we see the results, and yes, I have 2 years of data, but I kind of need the supplemental information to understand it better. So we can't just look at the numbers, but they certainly help us understand better. But we also need the other information that we've already learned. So again, they go hand in hand. And I guess what I'm trying to say is that the more information we have, the better decisions we can make. And that's the same for most things. All right. So next steps would be the midterm exam review or the exam review in terms of that. And I talked about that at the beginning. And I guess just looking at those exercises, the assignments, I will change the dates. I do have it written down here for you. But I did want to show you something else first in terms of, let's see here, let's do this. I want to show you a set of financial statements because they're kind of unique, and I'll tell you why I'm showing them in a moment. I just need to find them here and make sure I've still got them up. Okay, I do. So some of you might know the story. I'll just see if you know. Anyone familiar with Le Chateau? Anyone heard about that?
I am actually. I worked for Group Dynamite, which is a competitor. They bought the building actually for about 5 years.
Okay, so you're familiar with the store. And so this is their company website. I'm on the Investor Center here. And I think I had, yeah, these are their statements, but it's women's clothing, it's men's clothing. It's basically a fashion retailer. They've been around for so long, since the late 50s, I think, from the 20th century. But they've been around for a long time, and it was very popular in the 80s, men's and women's, you know, et cetera. So it's kind of a Canadian success story. It was a Canadian success story shop, but it experienced a few problems in the last 5 or 6 years. And we had always used their statements as examples in class because we just couldn't understand how they stayed in business. And so on November 2nd of this year, they announced that they are going into bankruptcy proceedings. And I guess for a lot of us, it's like, oh, finally, not that that's good news, but we're wondering how over all these years have they been able to stay in business? So I think it was COVID. I think COVID just kind of pushed it over the edge. Back in 2016, I believe, or maybe it was 2015, there's a note on the auditor's report that indicated a going concern. And we'll talk about what that is in a minute. The next year, it disappeared, and we never saw one after that. So, okay, well, that changes perspective a little. But as of, so their year end is January 25th, 2020, just before COVID. And the auditors is publicly traded. They need audited statements. This is what it's telling us. The auditor is saying, yeah, everything looks great. We did the review, no concerns, except for this one. This material uncertainty related to a going concern. The auditor, this is the auditor's warning statement. So we draw attention to note 2, which we'll look at in a moment, which indicates that the company incurred a net loss of 69.2 million during the year ended. And as of that date, the company's working capital deficiency is 44.3 million. As in note 2, these events or conditions, along with other matters as set forth in note 24, indicate that a material uncertainty exists, material uncertainty, that casts significant doubt on the company's ability to continue as a going concern. And they did not modify their opinion. Everything, I mean, they're auditing these statements that management prepared, and they prepared them in accordance with GAAP, which is great. Their warning is, we don't think the company's going to make it. We just don't. And of course, November 2nd, after COVID, they just could not. They tried to restructure year after year, and it just couldn't survive. I think I've mentioned this before. The founder of Le Chateau, the Siegel family, they in 2012, somewhere around there, 2013 maybe, they started David's Tea. The grandchildren were sitting on the board, and David Siegel is, of course, the tea company is named after. It did very well, and that has not been doing well the last couple of years. And again, probably a COVID response in terms of keeping it together. So here it is again here. It keeps resurfacing, this going concern uncertainty. Note 2, it's a red flag. And what they're doing here is they're reminding users that, don't forget, we told you this in the auditor report. And this is why the numbers look the way they are. So if we looked at the current assets and we see the receivables turnover, we see the inventories, the inventory turnover was always an issue. And if you calculate it, actually I did write down the cost of goods sold earlier, and the inventory turnover is horrific. I mean, they just couldn't sell inventory. And so we were wondering, if you can't turn over inventory and it's every 400 days, then how are you surviving? And finally, they just couldn't sell enough. And they really tried to sell a lot of their big shops. It was expensive real estate. They tried to convert online, and they just couldn't do it. So here we are. But as you can see from a lot of the financial statements, the deficit has plagued them, and it just increases year after year. If you go on to note, where is it here? This is a cash flow statement. right here. Basis of preparation and going concern uncertainty. If you did the financial ratio analysis here, you would see why the auditors, it's not going to work this time around. Management again here is identified. They're required to identify when events or conditions indicate that significant doubt may exist about the company's ability to continue as a going concern. And there's a significant doubt about the company's ability to continue as a going concern would exist. When relevant conditions and events considered in the aggregate indicate that the company will not be able to meet its obligations as they become due for about 12 months of the balance sheet date. So they already knew by January 20th that, you know, they didn't do the audit on January 20th. They have 6 months to file their statements after that. So as COVID was happening and they were doing the audit or finalizing the audit, they already knew this was going to happen. So here we are. They've shut their doors. We go back to their website and all you see is discount, clearance, get rid of this stuff. So everything's on sale because they have to clear it out. I don't know how long they have to do that, but it's going. It's happening right now. So just a quick kind of ratio. If we look at the current ratio here, just to get a better sense of how able they would be to pay their current liabilities based on last year's results. If we took the current assets, which is 79,067, and we divide it by the current liabilities, which is here, 123,413, we don't even need to do the ratio because there are more current liabilities than there are current assets, so that's a problem. We're at 64 cents. So for every dollar of current liability, they would have had 64 cents to pay them off. And whoops, that's just not sustainable. If we do it for the prior year, for 2019, 89,934, whoops, 89,934, and divide that by total liabilities, 42,661, we get a result of 2.1. So in 1 year, they've gone from having $2.10 of current assets to pay for every dollar of current liabilities to 64 cents. That's how quickly it happens. So again, there are other indicators here. We don't know about credit sales, so we'd have to assume that all sales are credit sales to do a receivables turnover to get an idea of what that might look like. Inventory turnover. If I do, I can do cost of sales maybe. I do have average inventory. I'll see what that is. So I'm going to do cost of sales is 69,654. And I'm going to divide that by average inventory, which was 81,290. I've already done my math ahead of time. And I come up with 0.856, 0.85, let's just say. It's not good. Divided by, 365 divided by 0.85. So we're looking at about 429 days. Every 429 days, they're turning over inventory on average. So not good. 0.85 times a year. It's not even one. So they're in bad shape, and it has been like that for quite some time. So I know just by doing two ratios that this is probably not going to be good. If I go and look at a profitability ratio, here we are here. Let's cash flow. Let's go to the income statement here again. Even if I did, I don't even have to do it. It's negative. It's a loss. There is no profit margin. There is no profit. Look at this. Negative earnings per share, 231. So I don't have to go too far. Results from operating activities, negative. Negative the prior year. Negative the prior year. And if you look at prior statements, it's negative as well. So it's been really hard to generate equity or retained earnings when you have losses for all that time. Yeah, it's been a really sad story with Le Chateau. So it's finally closing its doors. Anyways, I wanted to show you that just as an example of how significant the auditor's report can be in terms of this going concern and the disclosure that's required. Yeah, anyways, lots of good information here. Are there any questions about anything that we chatted about this evening? So,
I'm good.
You're good? Okay. If you're interested in looking at the information about a company, I mean, you can just go on to the Globe and Mail, click on the investor page, you type in the name of the company, it should come up and all the information is there. You have 3 days, 1 day, 5 days, 2 months activity, and all this, the financial statement analysis is provided there by the analysts. So you can get a pretty good idea about what that looks like for that specific company. And of course, they're publicly traded. So you can have all the information at your fingertips. So it's a good exercise just to sort of see where companies are at. And what's better about it is that when you read it, you actually understand what it means and what they're telling you. So it's, I guess, a good test to look at the data and the results and determine whether or not that is something you can use to make a decision, and how you would explain it to somebody else. That's the key thing. All right. Well, I'm happy to take questions here now. If not, I will get you up to speed in terms of what the exam looks like. So give me till about Wednesday to do that. Wednesday is going to be my catch-up day because it's a holiday. And I should have a pretty good idea about what that looks like and when you'll be able to access it. And time frame. Weekends seem to be the time to do that. And then after that exam is done, we'll be starting on the second part of the course, which is my favorite part. I mean, I love financial accounting, but the next part's more fun because there's no rules. So we do whatever we want. And it's just a little bit more fun. So I'll leave it at that then for this evening. I'll turn the recording off. Thanks to everyone who could join me.